analysis, what happens on the sensitivity is that we subject the key financial variables to their adverse changes. Then now we evaluate what effect will it be. So in the handout, sensitivity analysis is the first one. When you check through the handout, sensitivity analysis is the first one, where they were saying that under the sensitivity analysis, the key financial variables which influence the profitability of the project are identified and subjected to adverse changes in order to determine the extent to which the change will occur in the variable for the project to be rejected. So what normally happens, we have already accepted the project. Now we subject to adverse changes. Then you ask yourself, what can happen in this variable for me now to reject the project? So today after class, come to another one. What can make you not go home today? What is the key variable anyway for going home? The key variable of going home is the one of them is the fare, isn't it? So if we subject that to adverse variable, it should go up to what level for you not to go home? You normally pay how much? Or you spend how much to go home? Like 50 gold. So if you go there and you find it is 5,000. So what will you do? 5,000 is a lot. You can hire somewhere in town, you sleep with less than 2,000. Then the following day you continue with your job, isn't it? So those are the things we subject ourselves to. We, after accepting a project, you ask yourself a question. What can happen in this variable for me now to reject the project? So always that option should be there. I know I'm going this direction and I will get home. But you should also put in your mind that anything can happen in between. So that option is there. So that's now what we do in the sensitivity analysis. For the revenue to affect you adversely, it must reduce. But for the cost to affect you adversely, it will be able to go up. So they were saying that each key financial variable is normally analyzed in isolation. If the project has a positive NPV or IRR, which is greater than the cost of capital, then the normal condition is that the project will be accepted. Then sensitivity analysis is carried out from two perspectives as follows. So there is the break-even point analysis. At break-even point, total revenue should be equal to total cost. Therefore, NPV must be equal to 0. Then also this analysis normally attempt to determine the percentage change of the key financial variable that will occur for the project to be rejected. So for the break-even point analysis, we shall be looking for a change in the variable so that we can reject the project. But for the impact, they normally give you the change. So I simply want us to go straight to some of the questions in your past papers, which has an effect of the simulation analysis. We simply check some of the sensitivity analysis. We check some of the key questions in your past papers with the sensitivity analysis. So the last time they tested was November 2019. November 2019, there is a question number 1, part B. November 2019, there is a question number 1, part B. November 2019, there is a question number 1, part B. So that question 1, part B, when you go to your past papers, November 2019, they were asking that Sun Technologies Limited is considering investing in a shillings 50 million in a new machine to manufacture a computer microchip with the expected useful life of 5 years and no salvage value. So it is expected that 20 million units of the microchips will be sold each year at shillings 3 per unit. Variable production costs are expected to be 1.65 per unit, while the incremental fixed cost will be 10 million per annum. So cost of capital is 12%. So required, evaluate the sensitivity of the project net present value to the following changes. The first one is sales volume. The second one is the sales price. The next one will be the variable cost. So you want to get the change in those variables for the NPV to be 0. So we shall be making each variable to be X. Then we make NPV to be 0. Then we work backwards, we get that value. Then we compare the figure that we shall be getting against the one that is given. Then we get now the percentage change in that variable. So at break-even point, normally at break-even point, NPV should be equal to 0. So at break-even point, NPV should be equal to 0. NPV should be equal to 0. Then we also know that NPV is supposed to be given by present value for the cash inflows. We minus the present value for the cash outflows. Then I had shown you a formula on how to get the annual cash inflows. How to get the annual cash inflows. So annual cash inflows, it was meant to be P minus V, then X minus F. Then you remember this part, you are multiplying by 1 minus the tax rate. Then you are to add depreciation multiplied by the tax rate. You are to multiply depreciation by the tax rate. So we had seen that formula before. We had seen that formula in our previous class, how to get the annual cash inflows. But the question did not provide for the tax. The question has not given us the tax. Now that there is no tax, we shall ignore this region. Now that there is no tax, we shall ignore this part and that element, because the question has not given us the tax rate. When there is no tax, we avoid depreciation. So finally, to get our annual cash inflows, I will only be using this part because now there is no tax. We shall now only apply that to give us the annual cash inflows. So we start with this first item, Roman letter 1. Roman letter 1 is the sales what? Is the sales volume. Is the sales volume. So that sales volume, we make it X. That sales volume, we make it X. So that now our annual cash inflows. Our annual cash inflows will be. So P is the selling price per unit. You can see P is given as how much? We have been given 3 shillings. We minus B. B is the variable cost per unit, whereby we are given which figure? 1. So the sales volume, we make it X. Because it is the one we are analyzing. We don't know that item. So we just make it X, then we subtract. We subtract, you can see the fixed cost. The fixed cost was given as how much? It's 10 million. So when we open the brackets, 3 minus 1.65, that figure should be what about? 1.35x minus 10 million. So that's now our annual cash inflows. our annual cash inflow. So we compute now the present value of the cash inflows. So to get the present value for the cash inflows, it is annuity multiplied by the present value interest factor for the annuity. So we know that the cost of capital in the question was given as 12%, and the project was for how many years? It was for 5 years. So 12% for 5 years. So annuity, our annuity is what we had calculated up there. Our annuity was 1.35 million minus 10 million. So this figure is our annual cash inflows. So we check now in the table. What is 12%? What will be 12% in year 5? What will be 12% in year 5? 3.6048. Yeah. So when we open the brackets, I want you to confirm to me that part. Sorry, this is not M, but X. When we open the brackets, 1.3x multiplied by 3.6048, it will be able to give us around which value? So that's 4.6648 x. Then we subtract. When you multiply 10 millions by 3.6048, it will be 36.048 million. Then we now less present value for the cash outflows. So present value for the cash outflows is the initial cost of the project. It was costing how much? It was costing 50 million. So when we subtract the 50 million, we get NPV, but that NPV must be 0. We get NPV, which must be 0. So now we have our equation, which is supposed to be 4.86648x minus 36.048 million minus 50 million. We should come up with a 0. We should come up with a 0. So we collect now the like terms. Then we make x to be the subject. Make x to be the subject. So this one and this one will cross. They will become positive. So that means you will now take, is it 86.048 millions? Then you divide by 4.86648 to get the value for x. So that we get now the value for x. So when you make x now to be the subject, it should be able to give you which value. When we make now x to be the subject, what value should we have at that point? So X should be 17.68 million. Yeah, so we want to get the percentage change in that variable. We want now to get the percentage change. So percentage change, we take the one that we have just calculated, it is 17.68 million. But we had been given one before. The one given was which amount? The sales volume. They had given us how many million units? 20. Yeah, so minus 20 million. Also divide again by 20 million to see it has reduced by what percent for the NPV to be equal to 0. So we are now establishing sales revenue, sales volume should reduce by what percent for the NPV to be negative. For the NPV to be negative. Sorry, to be 0. So inakuja what percent? 11.59. Yeah, so that is now Roman letter 1. The percentage change in the sales volume for the NPV to be 0. So that's now the effect. Are we all getting 11%? It is 11 point something, not it? 11.6. Online, you are getting which percent? Online, it is 11 points. Because of the rounding off. Yeah, so roughly it is 11.6. Yes. Okay, you have also seen 11.59. So roughly we can have it as 11.6%. We can have it as 11.6%. That's now the percentage change in the sales volume for the NPV to be equal to 0. So let us now go to Roman letter 2. Yeah, I said for revenue to affect you negatively, it must go down. Sales volume must go down. But when you get a cost, it will be positive. But anything to do with the revenue, it will be negative. Yeah, for our revenue to, because this is affecting the sales revenue. Sales volume has a direct connection with the revenue. So it will go down. It will be negative. Yeah.
In the presentation of the answer, you put the negative.
No, you just put there negative. Yeah, you show the negatives. But it is implied. It is already implied that for our revenue to affect you adversely. Yeah. It is bankrupt, isn't it? Yeah. Yeah. But for the cost to affect you adversely, they must go up. So it is always implied. Revenues will be negative, then costs will be positive. So we go to the Roman letter 2. Roman letter 2 is the selling price. We go to the Roman letter 2 as the sales price. So we go back to this point. We go back to this point. We are now on the sales price. So I'm making it X because X is so common to be unknown. I'm making it X. So I start afresh. You see my annual cash inflows. Yeah. Where there was the selling price, I change it to X. It is the one which is affected. The rest would not be affected. So the sales volume will go back. Initially it was 20 million. Then we subtract the fixed cost, which was 10 million. So that we now get our annual cash inflows. So where there is everything remains the same, but now the selling price becomes what? X. So when I make it X, it will be 20 million X. When I open the brackets, 20 million X, then I subtract. When you take 1.65 multiplied by 20 million, 1.65 multiplied by 20 million, you should be able to give us the figure. Exactly 33 million. Yes. That's 3 million. Then you also minus 10. So finally, our annuity is going to be 20 million x minus negative 3 minus 10. It will be 40 what? It will be minus 43 million. Yeah.
20x minus 43.
Which one? You have just opened the brackets. This multiply this, yakakuja hiyo, sindio? Hii multiply hiyo, ikakuja hiyo. So it is 3 minutes. Then sasa tena hiyo. So we are negative 33 million, also negative 10 million. So finally to be negative 43 million. Yeah. Yeah. So now we come here in our annuity. We come here. Everything is remaining the same, except now your annuity will now be 20 million x minus 43 millions. Then now we come at this point. Now we come at this point. So everything is remaining the same. We are only making changes in the selling price. We are only making changes in the selling price. So now we come here, we take the 20 million x, multiply by 3.6048. Sorry? 72.96 million x. Then we subtract 43 millions multiplied by 3.6048. Sorry? 155. 155 point what? 00. Like that. Yeah, so this 50 million is remaining, it is not changed. So that NPV is equal to 0. So that NPV is equal to 0. So that now our equation is going to be, $72.096 million x minus 155.0064 million minus 15 million equal to 0. Now we also make x the subject again. We now also make x to be the subject again. So I've been given 2.15. Online, someone has given me 2.15. It should be 2.84. Exact. I'm around it.
Okay, round it.
We can round it off. Let us round it off maybe to 3 decimal places. Sorry, 2 decimal places. 2.84. So it is going to be our x is 2.84. So we want to get the percentage change. Percentage change in the variable. So selling price, we have been given which here. So we have gotten 2.84, but we have been given 3. Also divide by 3 and get the percentage change in that variable. So it has gone down by what percent? Negative 5.33. Okay. So it has gone down by 5.3. So that is now the percentage change in the selling price for you to reject the project. The next item is the raw mandata 3. Raw mandata 3 is what? Variable cost. Remember, for sensitivity analysis, you repeat everything the way it is, except the one specified. All other variables are held constant. You only make the variable in concern to be X. So we go to the raw mandata 3. We go to the raw mandata 3. So this raw mandata 3, we are making variable cost. We are making the variable cost now to be X. So you repeat again. You see our questions. So this selling price will go back to 3. But now the variable cost per unit, we make it X. So that we now will get the annual cash inflows at that point. We now get the annual cash inflows. So 3 multiplied by 20 million will be the same as what? So this will be 60 millions. We minus 20 million X. We also minus what? 10 millions. We also minus 10 million. So finally, it will be 60 million minus 10 million. So this one will be 50 millions minus 20 million X. Like that. So we come back to this point. We now get to this level, whereby we change this figure to 50 millions minus 20 X. So that we now get the new annual cash inflows. Now get the new annual cash inflows. So 50 millions multiplied by 3.6048. Sorry? 80.24 minutes. So we subtract 20 millions X multiplied by 3.6048. 72.96 million X. So the rest is remaining the same, so that NPV becomes a 0. The rest is remaining the same, so that NPV becomes a 0. So now in our new equation, we shall be having 180.24 millions minus 72.096 million X minus 50 millions. We should get a 0. Minus the 50 millions, we should be able to get a 0. So make X to be the sum, because it is the one now to cross, because it is negative. So when it crosses, we shall 50 million, when you subtract 50 million from 180, we are left with 130.24. So it should be equal to 72.096 million X. So we simply take that 130.24 millions divided by 72.096 millions, so that we get X as the subject. So that we make X to be the subject. Two point
1.21.
X is going to be 1.8. 1.8. What is the exact time of round off? So let us just have it into 2 decimal places. 1.81. So we have it as 1.81. So we are looking for the percentage change. We are looking for the percentage change. So it is 1.81. Initially, they had given us 1.8. Yeah, so this one it is positive because it's a cost 1.65. Also divide by 1.65. Then we show it as a percentage. So this one has given us what percent? Yeah, so sometimes they normally ask you to comment among those variables, which is the more sensitive or least sensitive. So when they ask you that kind of a question, you summarize it in this manner. You simply summarize it in this manner. So for you to comment, you will be having the key variable, the key variable, the key variable, then percentage change, then comment, percentage change, then the comment. So the first variable, you remember it was what? From letter 1, was it sales volume? So sales volume, you say it was one negative what? 11.6. The second one was the sales price. Negative what? Negative 5.3. Then hiyo ya mwisho tunasema ni variable cost. So for the variable cost, unaniambia ni 9.7. Yeah, so always when you are a financial manager in the organization, what should be influencing your decision is only revenue. You should always be concerned about revenue. And revenue in this case is the selling price, because the one which influences also the sales volume. So this one requires a very small change for you to reject. You see this one, once the selling price reduced by only 5.3%, you are going to reject. So this one becomes most sensitive. It becomes the more sensitive because it requires the smallest change for you to go out of the better decision aspect. Then this one is the most, because it requires, it is the least. It requires a lot of change. Even if it is negative, but it's a very big change. Then this one is moderately sensitive. Moderately sensitive. So that's now how we shall be able to comment. So that's now for the question. This part was not required, but some questions they normally ask you to comment about the most sensitive. So prayers in the fika. So we can have a short break for the prayers. Then we come back, we start another question, still on the same area.
Sixty questions. Always equal motivational. Kama hivyo tunaweza price everybody around ajaandika anything wongo page 7. When utaku hii mwaka wasifanye vibaya, especially tuna focus ya the people kama ni watakoya ni nani usikue watiaji. Na kama hawawezi kufanya hivyo, tutaenda siku ya lini kama tutakuwa na that is Kibra. So they either give us good grades or we disappear with that yeah. You insist you need a remarking. Risk is not an option. Education the exam will be cancel. We know our rights. Kwani sisi tumelipa taksi wakamsema na zikatumika. Hawa watu wanasinagopa ndogo na safi na mimi kati yangu.
I'm sorry. So,
Have a good day. Hi friends. My friends. Endelea kuomba. Endelea kuomba ifanyike kwa jana.
So another question should be November. I want to do one more other question on the break-even point. So it should be November 2015. We can also check a question. November 2015, question 1, part B. November 2015, question number 1, part B. So we go through November 2015, question number 1, part B. So we go through the question for November 2015, question number 1, part B. So that question 1, part B for November 2015. So the question reads that a company is considering whether to purchase the equipment to increase its production and sales volume. To increase its production and sales volume. The equipment will cost shillings 500 million and it has a useful life of 3 years, after which it can be sold as scrap for shillings 80 million. For each of the 3 years of the usage, the equipment is expected to increase both the sales revenue and operating cost by 600 million and 390 million respectively. The company's cost of capital is 10%. Now required, compute the percentage change. They would like you to calculate the percentage change required in each of the following factors for the project to be rejected. For each of the following factors for the project to be rejected. So at the moment, we are looking for the change in the factor for the project to be rejected. That will be the break-even point analysis. So sometimes they can be on the impact analysis. So on the impact analysis, they will give you the change. They may say that like now initial cost, they may say it can go up by 10%. So they will give you a change for the impact. But for the break-even point, we normally look for the change. So they are asking you to look for the change in the variable for you to reject. That means it is a break-even point analysis. But when you get a question where they have given you the change in the variable, that means it is the impact analysis. So we shall see when the impact analysis will be able to work. But for now, we are dealing with this one, which is on the break-even point. So we start with the Roman letter 1. Roman letter 1 is initial cost of the equipment. Initial cost of the equipment. So Roman letter 1 is the initial cost of the equipment. Initial cost of the equipment. So we make it X. The initial cost for the equipment, we make it X. Then you remember we said that this time round, they have not annual cash inflows. Annual cash inflows will simply be revenue minus the variable cost, because the question had no fixed cost. They only gave you something brief about sales revenue and what? Operating cost. So we shall simply be taking the sales revenue, we subtract the variable cost. So this question had no fixed cost. Also, it has no tax, so there is no need of us depreciating. So to get the annual cash inflows, we simply take the sales revenue, we minus the variable cost. So sales revenue, the question had given us a figure, which is 600 million. Then variable cost, we had also been given a figure, which was 319 million, which is going to be how much? To 10 million. So we are saying that at break-even point, NPV must be equal to 0. So we start off with the present value of the cash inflows. We start off with present value for the cash inflows. So there are 2 items because it also has a salvage value. So it will be annuity multiplied by present value interest factor for the annuity Remember, the cost of capital is given as what percent? 10% for how many years? 3 years. So our annuity is the 210 million. Like that. So confirm in the table what is there as 10% in year 3 in the annuity table. Now, what out here? 2.4869. Yeah, so when we multiply, what should be our present value for that cash inflow? Sorry? 522.249. So that is now for that. But there was also the salvage value. Salvage value only occur once. Salvage value normally occur once. We normally discount it using the first table, 10% in year 3. So you can see in the question the salvage value, the scrap value is the salvage value. They are given us 80 million. So it will be 80 million. So confirm also in the first table. What is there as 10% in year 3? 0.7513. Yeah, so when we multiply, it should be around 6 crores. 60.104 million. So when we add them together, that is now when we shall get the present value for the cash inflows. So it must be 500 and what? 582.35. Then we are supposed to less present value for the cash outflow, which is now the initial cost of the product. But it's the one we are analyzing, isn't it? Yes. We make it X so that NPV becomes a 0 like that. So we make initial cost as a 0. So that means X will be the same as what? The same as 582.353 million. Yeah, the X is the figure when you minus from that you get a 0. So to just be the same as the other value. So now we get the percentage change in that variable. We simply now compute the percentage change in the variable. Percentage change in. So percentage change, you take 582.353 million we minus. So the question had given you sugar. You can see there 500 millions. So we subtract the 500 millions. We also divide by 500 millions. So that one must go up because it is a cost. You will get a positive value because it is meant to be a cost. You get a positive value because it is meant to be a cost. Remember, do by what percent? 16%. Yeah, so that's now our Roman letter 1. So we go to the Roman letter 2. So Roman letter 2 is about what? The scrap value of the equipment. So our Roman letter 2 is the scrap value. The scrap value. The scrap value So that scrap value is now the one we make it as X. So everything remains. But now you only change this one. You see the scrap value was 80 million. We change it to what? X. So the rest are remaining the same. Now this one should be 0.7513 X. Then now when it comes to this part, you simply take 522.249 millions plus 0.7513 X. Then this one, you remember it goes back to where it was initially, which is 500 million. So that NPV becomes a 0. So we analyze each item in isolation. So that now your new equation should be 522.249 millions plus 0.7513 X minus 500 millions should be equal to 0. So everything remains. We only now make the scrap value to be X. The rest of the details, they go back to where they were initially. Then we now look for X. Now look for the X. So I've seen 29.61 and also seen 628.58. 29.61. Yes. It's the revenue. Yes. Scrap value. Yes. It will always be. You see, something like when you have a vehicle that has stalled, when you are parking somewhere, you are paying. So you incur extra cost to dispose it. So the scrap value, you incur more cost on it to dispose it. For some items, you cannot use them anyway. So when they are spoiled, you incur extra cost to go out to dispose it. That's why that scrap value is negative. Now, you have incurred extra cost to dispose of that item. Or sometimes you pay parking fee for item that is not working. So that is now what is meant to do. So to get the percentage change, you take what you have calculated as negative what? Negative 29.61. Yeah. Then remember initially it was how much? It was 80 millions. You also divide by 80 millions. So you express it as a percentage. So it will be negative 137. So the scrap value, it is negative because this person incurred some extra cost in disposing of that item. So that is now our Roman letter 2. We go to Roman letter 3. Roman letter 3 is what? Sales revenue. We now go to the Roman letter 3 as the sales revenue. So we make sales revenue to be the subject. We make the sales revenue. So we make it X. Make it X. So sales revenue tunaanzia tumeifanya X. So that our annual cash inflow is now X minus what? 390 million. So our annual cash inflows will be X minus the variable cost, which is 390 million. So it will have an effect only at this point. So whereby it will be X minus 390 million. But this one go back to 80 million. So when we open the brackets, so when we open the brackets at this point, it will be 2.4869 X minus. So 390 million multiplied by 2.4869. Correct? 969.891. Then hii ngine mnakumbuka 80 million multiplied by 0.75. It was 60 point what? 60.104. 60.104. So that now your equation should be. Now our equation should be 2.4869 X. So remember this one we are adding here, but this one is a negative. So negative 969.891 million plus 60.104. So it will still be negative, right? So it will be negative 90 what? Negative 909. 9.787. Like that. Yeah. Because we are at this point, you see this is 2.4869x minus 969.891, but we add 60.104 million. So it is just this one, but because it is negative, but this one we are adding. So it just reduces the 969 to the value. So then this other one will remain the same, so that NPV becomes 0. So that NPV becomes 0. So now our equation should be 2.4869x minus 909.787 millions. Then we also subtract the 500 millions, so that NPV will be equal to 0. X inapita ngapi?
566.89.
So X is
566.89.
so percentage change. Percentage change will now be 5.89 minus. Initially it was which way?
600.
So they have given you 600 millions. So you also divide by 600 millions. Then we express that as a percentage. We express that as a percentage. So those two questions were on the break-even point analysis. Those two questions were on the break-even point analysis. So I want us now to go to the impact analysis. I also want us to, so that one is giving us negative what? 5.5. So let us now go back to your notes. The two questions we have done were on the break-even point analysis. Now, the next ones will be the impact analysis. We want now to check something brief on the impact analysis. So when it comes to the impact analysis, they say that the analysis attempts to determine the change in the NPV. This time, it is not the change in the variable. It will be change in the NPV or IRR. If a given key financial variable will change adversely by a given percentage. So for the revenue to affect you adversely, it will decrease. There is a misspelling there. You can see that decrease is not correctly spelled. So for the revenue to affect you adversely, it will decrease. That I should be E. Then for the cost to affect you adversely, it will do what? It will increase. So I want us to get a question to distinguish between the break-even point analysis and the impact analysis. So impact analysis, they will give you the change in the variable, so that now you come up with the change in the NPV. So the first question I want us to use, there is one, December 2013. December 2013, there is a question number 2 part F. December 2013, there is a question number 2 part F. December 2013, there is a question number 2 part F. December 2013, there is a question number 2 part there. So mine is on page 81. Mine is on page 81. No, your papers. 75. Yeah, you can either check 81 or page 75. There is a question number 2, part A. So that question 2, part A, they were asking that R Limited is considering a project with the following cash flows. R Limited is considering a project with the following cash flows. So they gave you the year 0, 1, and 2. They have given you cost of the plant, then running cost, and also the savings. So our limited cost of capital is given as what percent? 9%. Now required. Determine the sensitivity of the project to changes in the level of the cost of the plant, running cost, and savings, considering that each factor at a time and assuming each factor is varied adversely by 10%. So when they give you the change, you see they have given us 10%. Yeah, when they give you the change in the variable, it is impact analysis. But when they ask you to calculate the change in the variable, it is the break-even point analysis. So this time around, they have given you a change in the variable. It affects you adversely. So there are 3 items there. You can see the cost of the plant. That one to affect you adversely, it should go up. So you increase it by 10%. You increase it by 10%, you get the new NPV. For the running cost, you also increase it by 10% because it is a cost. But for the savings, you reduce it by 10%. Then you get the new NPV. So always remember, when they give you the change in the variable, it is impact analysis. But if they ask you to calculate the change in the variable, that is break-even point analysis. So you need to know that specific area. So this one, they have given us the change in the variable. So when they give you the change in the variable, we shall be comparing NPV before sensitivity analysis and the NPV during the sensitivity analysis. So that we get that percentage change in the NPV. So first, we compute the NPV without subjecting it to sensitivity analysis. That's for the impact. When it comes to the impact, you first of all calculate the NPV without subjecting the project to sensitivity analysis. Then you compute the new net present value, subjecting each variable to those changes, subjecting each variable to those particular changes. So let us just get the normal NPV. So NPV is supposed to be given by present value for the cash inflows minus the present value for the cash outflows. So I'm just calculating the normal NPV before I subject the project to the sensitivity analysis. So because those cash flows will not be the same, I will use the first table. So we shall be having the year, then cash flows, then present value interest factor. So cost of capital is given as 9%. Let's see the cost of capital. So we shall be using 9% for each year. 9% for each year, so that we get the present value like that. So in year 1, we simply take the savings, which is 12 millions, we minus running cost, which is how much? 4 millions. Can you see that item? So when we subtract, what should be now the cash flows? 8 million. So I would have 3 zeros at the top. We're having 3 zeros at the top. So we go to the table, confirm 9% in year 1. Confirm 9% in year 1. 0.91. Yeah, so when you multiply 8,000 by 0.9174, it will be able to give you which figure? 7 millions 339 point 2. That is now for year 1. We also go to year 2. So year 2, you can see the savings is 14 million. We subtract what is meant to be the running costs. Running cost is how much? So that difference will give us which here. So it is 0. What in the table? 417. So when we multiply, it will be able to give us 7. 0.3. So add them together to give you present value for the cash inflows. To give us 14. Sorry. 0.5. Then now we less the present value for the cash outflow is the initial cost in year 0. You can see the cost of the plant in year 0. They gave us 10 millions. Yeah, so you subtract 10 millions so that we come up with the NPV. So it is simply 14.5. Yeah, so that's now NPV without subjecting the project to sensitivity. So under the impact analysis, always get the NPV before subjecting the project to sensitivity analysis. Then you go to each variable, you subject it to the sensitivity analysis, you calculate the new NPV and compare this NPV and see it will change by what percent. So we go now to the sensitivity analysis. The first item there is the cost of the plant. Let us now analyze the first item as what? Cost of the plant. Cost of the plant. So our first item is meant to be cost of the plant. Cost of the plant. So when it comes to the cost of the plant, it is to affect you adversely. It varies by 10%. So we shall be getting, it has gone up by 10%. You get 1/10% of the 10 million. The cost of the plant is 10 million. So increase it by 10% by multiplying by 1/10% of 10 million. So what should be 1/10% of 10 million? In 11 million. So everything remains what we have done. But now we change this figure to 11. We get the new 10. Everything remains. But now the cost of the plant, we change it to 11 million to get the new NPV. Get our new NPV. So everything remains. So that we get the new NPV. Because it is only the cost of the plant which has changed adversely. It has gone up by 10%. The rest of the variable, they don't change. The rest of the variable, you repeat exactly what we have, then get the new NPV. We get the new NPV. You only increase the initial cost by 10%. That means you get 110% to give you the new variable. Then get the new NPV. That means our new NPV will be which year? 3914.5. So we need to get the percentage change in that NPV. So percentage change in the NPV, you take 3914.5, subtract 4914.5. Also divide by 4914.5, because that is the one we got initially without subjecting it to sensitivity analysis. So that NPV has reduced by what percentage? When we increase the initial cost by 10%, when we increase the initial cost by 10%, that variable should change by what percent? It has gone out by, yeah, so that is now for the cost of the plant. So we go to the second item. The second item is which item? After the cost of the plant, what was the next item? Running cost. So let us now analyze the running cost. We go to the second one, which should now be the running costs. The running costs. So running costs is this item here. You see our running costs. We increase them by 10% before we subtract from the savings. So just multiply these figures by 110%, then subtract from the savings to get the cash flow statement. So we just summarize it in this manner. We just summarize them in that manner. So year one, when you take 12 million minus increase in the running cost by 10%, the difference will give us which year?
7,600.
So that will be now for year one. Also confirm for year two. Also confirm for year two. Year two cash flows will be how much? Exactly 85. Yeah, so 9% each year they are not changing. So we multiply so that you get your present value for the cash inflows. So initial cost now it will go back to what was there initially. Remember, initially it was 10 millions. So you subtract the 10 millions to get now the new NPV. So that we get now the new NPV. So what should be our new NPV? 14,
126.
126. That's 60%.
Yes. See, before we subtract.
When you subtract NPV,
41, 26.
41,
26.
26 point what?
6.
Yeah, I was asking just for the NPV. So now you get the percentage change again. So to get a percentage change, we are changing this one to 41, 26.69. The other one will remain and we get the new percentage change. The other one will remain so that you get now the new percentage change. So that one will reduce by what percent? 16.03%. So we go to the last one. The last one was which item? Yeah, so we now analyze number 3 as the savings. Number 3 as the savings. So for the savings to affect you adversely, it must reduce. So we shall be getting 90% of the savings. So these others will go back to where they were. You see the running cost, they will go back. But these savings, reduce them by 10%, whereby you get 90%. We get 90%. We get 90% of the 12 million before you subtract the 4 million. And so this one, we shall be coming up with 90%. So that we get now the new cash flows. So for the savings to affect you adversely by 10%, we reduce it to 90%. Then we get the new annual cash flows. So how much cash flows now will be there for year 1? Year 1 is 68. That's 6,800. Yes. Then year 2, it will be which year? 76. So get now the new NPV. So the process remains. Then we now get the new NPV. The process remains. So we now get the new NPV. So what should be your new NPV? Sorry? 2635.24. So this time, Roman letter 2, they wanted you to comment. Roman letter 2, they were asking you to comment on the factor which is most sensitive to adverse variation. Comment on the factor which is most sensitive to the adverse variation. So we make a structure on that. Make a structure on that. So we should be having the key factor. The key factor. Then percentage change. Then we comment. Then we comment. So the first factor was meant to be cost of the plant. The first factor was cost of the plant. Here it pair which percent? 20%. So then, negative 20.35. Then the second one is meant to be running cost. So running cost ngapi? Negative 16.03. Then the last one is the savings. So savings is what percent? Negative 46.4. 46.4. Yeah. So which one would be now the most sensitive? Remember, we are looking at the reduction in the, which one has reduced NPV with a big margin? To compute the decrease in the NPV. So when it comes to the impact, we take the most factor that has reduced NPV by a very big margin. Yeah. So we are comparing the NPV without sensitivity and NPV with sensitivity. Yes. So they are reducing NPV. So the most sensitive is the one that has reduced NPV with a big margin. So for the impact, you take the big change. For the break-even point, you take a small change because this one is NPV. So this one has reduced NPV by 46.4%. Once you reduce the savings by 10%, then I said it is just by implication. In an organization, what is most important is revenue. In fact, most managers are only concerned about revenue because for the cost, there is a budget. Once you collect the revenue, the budget will be met. But if you prepare a budget and you cannot generate revenue, then it will not go. So always, even if you have not done the question, because they were simply asking you to do it. So they wanted you to give them which comment on the factor which is what? Most sensitive. So just speak anything to do with the revenue in the question, which is what? The savings. It is obvious it will be the one which will have reduced NPV by a very big margin. So this one is the most sensitive. This one is the most sensitive. This one will be the list. This one is moderately sensitive. So because the question only wanted the most sensitive, so just pick the what? Anything to do with the revenue. So I will do more other question in our next class. Then we conclude. So sensitivity has never been tested since the first question was it May 2019. Yeah, since then they have not tested anything on sensitivity, but simulation and decision tree, they have tested each setting continuously until the one for the last sitting. So sometimes we predict them from that angle. They are likely to come back, but now with sensitivity analysis, because they have not tested anything on sensitivity, but continuously they have tested simulation and decision tree diagram since 2019, November, until the last sitting. Every sitting, they must test a question, either on decision tree or simulation. So they have been required on that sensitivity analysis. That's now why we assume this time round, they are likely to test in the same topic, but now on sensitivity analysis. So I will do one more question in our next class so that we conclude sensitivity analysis. Then that topic, the key ones are the three: sensitivity analysis, simulation, and decision tree. Those are the ones they normally test. So once we finish the sensitivity, the remaining part will be something very small, which we should do in one lesson. Then we finish the topic. So I'd send some notes to the class group: mergers and acquisition. That should be our next topic. That should be our next topic: mergers and acquisition. So make sure for those who are online, you get those notes, so that once we finish this one, that should be our next topic. So online, make sure that you get those notes for mergers and acquisition. When we meet, we finish that part, then we start on the mergers and acquisition.